Hi, there is a question that should make every accountant uncomfortable. What if the cash flow advice you're seeing everywhere, all the articles, all the popular press, is actually destroying your client's business? I'm talking about the strategies that show up in every single improve your cash flow article. Factor your receivables, offer early payment discounts, delay paying your vendors, cut costs massively. These strategies work. They absolutely get the cash in the door faster or delay having the cash go out. But here's what the articles do not tell you: these exact same strategies are quietly but slowly and surely bleeding your client's business to death. Think about it this way. If your client had a cut on their arm, you'd put a pressure bandage on it to stop the bleeding. That makes sense. It's emergency treatment. But you wouldn't keep pressing on that cut for the next 6 months, would you? You'd either have to give it stitches or it would be fixed. Once the emergency is over, you move to actual healing. Cash flow emergencies work the exact same way. Emergency strategies stop the bleeding. But if your clients keep using them month after month, they are not healing. They're just slowly dying with a bandage on. Stay with me until the end of this episode because I'm going to give you one specific action you can take this week to identify whether your clients are stuck in this trap and if they are, how to help them escape it. I'm David Saphir. I am the founder of Cash is Clear Learning Systems, and I help accountants become confident cash flow advisors who command premium fees. Let me give you a framework that will change how you think about cash flow advice. There are two types of cash flow strategies. Every single cash flow strategy falls into one of two categories. First, there are the strategies that improve both the short term and the long term cash flow. That's what I call foundational strategies. They might take longer to implement, but once they're in place, they keep working for you month after month. And these are strategies we cover in our lead magnet, Boost the Bottom Line, 24 powerful cash flow strategies you control. Look at the show notes and you can get it, or you see it scrolling across the bottom here, CIC60.com. Go grab that ebook. It's fantastic. Strategy number two are the strategies that improve short term cash flow for a while by destroying your long term cash flow and profitability. These are emergency strategies. They're like taking out a payday loan. Yes, you get the cash today, but you're making your future problems a whole lot worse. The tragedy is most businesses do not distinguish between these two types. And most advisors don't either. If they did, there wouldn't be so many articles that recommend short term strategies that kill your long term cash flow. They are 7 strategies. Well, these articles. Imagine the article, 7 Ways to Improve Cash Flow, where all 7 strategies are short term positive, long term negative, and then a company wonders why their cash flow problems never actually go away. Here's why accountants and business owners can get trapped by emergency strategies. A lot of them work immediately. You can pick up the phone and say, receivables, do you want to pay your receivable today and I'll give you a 5% discount? And the answer can be yes or no, but you can do it today. Factoring receivables, if you can do that, it shows up in your bank the next day. You don't have to wait for 30 days. The worst one is a merchant cash advance. And you've seen the advertisements. Get $50,000, $100,000 tomorrow. No credit check. It shows up 24 hours, 48 hours. All of these things makes it feel like you've solved the problem. But what actually happened? You traded today's cash flow challenges for tomorrow's cash flow problems. You didn't solve anything. You just moved the problem to next month and made it bigger. Let me show you how this plays out. Take a merchant cash advance. And this is my one strategy of my 236 cash flow strategies that I say, do not use this strategy. I warn people, and this is why. A client of mine was using merchant cash advances, and they come by different ways and shapes, but basically, they're the ones you can get money overnight, and there's no interest, just fees, and they suck the money out of your bank account every single week. However, those fees have effective interest rates of 60% or more. But it felt manageable to this client because they were just making small payments each month. But here's exactly what was really going on. Every dollar they borrowed cost them $1.60 to pay back. It's like running on a treadmill that is, really high and steep. You run faster and faster, but you're still not making any progress. And to give you some hard numbers, you borrow $40,000 deposited, and 60% would be $24,000. You'd have to pay back $64,000. Sounds good? It's terrible. It's killing companies. Or you can, let's do another one. Discounts for early payment. Sounds reasonable. You just give customers 2% off to pay within 10 days instead of 30. But you do the math. And 20 days early is roughly equivalent to a 36% annual interest rate. Would you borrow money at 36% interest to fund your operations? Most of you would not. But that's exactly what you're doing when you offer discounts. And sometimes it's, we need money in tomorrow. If I give you a 5% discount, I've known companies that give 10% discounts to get paid 20, 30 days early, and the cost is enormous. The most insidious part is that it seems like they're proactive, and business owners think, look at me, I'm solving my cash flow problem, but they're not. They're renting cash at predatory rates while their actual problems get worse. So, is there a situation when emergency strategies are appropriate? Yes, absolutely. They're not always wrong. Remember that cut on your arm? You got to fix it. You got to apply the pressure. You got to give yourself stitches or get somebody else to do it. But that's where it belongs, is in an emergency situation. If your client has an unexpected tax due in 10 days, well, it shouldn't be unexpected, because if they're working with you, you're going to help them know that they need to pay this tax bill, but they don't have any cash reserves. Well, then factoring to get some receivables in to pay that tax bill could be the right call, especially if the penalty exceeds the cost of the money. If they lost their biggest customer and need to cover payroll when they rebuild, a short-term loan for payroll might be justified. But every time I recommend to a company, oh, by the way, payroll line of credit, I recommend to every single company that they get a payroll line of credit from a reputable payroll lender. And my go-to is Payro Financial. If you want more information, let me know and I'll give you more information. This is not compensated. They work. My clients use them, and they're a great company to work with. Okay, let's move on. The key issue is short term. Emergency strategies should be measured in weeks, maybe a couple of months. If your client is still using these strategies 6 months later, it's no longer an emergency. It's just part of the way they do business. It's a chronic condition that is not being treated. Somewhere or another, you've got to go find the root cause. Now, here's how to identify if your clients are stuck in the emergency cash flow trap. The first signal, they're using the same emergency strategy month after month. Factoring receivables, giving discounts. It's no longer emergency financing. It's just expensive permanent financing. The second signal, they describe these strategies of part of how we do business now. Nope. Emergency strategy should never become business as usual. All right, signal number 3. They can't articulate what would need to change for them to stop using these strategies. They don't have an exit plan. They're not in emergency mode. They're basically in denial. And mindset is the biggest thing that needs to change before the financials change. All right, signal number 4, the percentage of revenue going to these strategies is growing, meaning the interest is growing, more debt, and it's not shrinking. If more and more of the cash flow is being consumed to serve these emergency strategies, that's when you're watching the death spiral happen in slow motion. So, what's the path to get out of the death spiral? When you identify a client stuck in the death trap of short-term cash flow strategies. First, you need to have an honest conversation. It won't be easy, but you need to talk to them not about the emergency strategies themselves, but the underlying cash flow issues and the problems that they're masking. What's actually happening is the emergency strategies are fixing symptoms, not the disease, not the real cause of the problem. And the real problems might be something like pricing that's too low to generate sustainable margins, customers who pay too slowly, chronically, inventory that's turning too slowly or not turning at all, operating expenses that are too high relative to revenue. It's cost reductions, which isn't fun, but sometimes has to be discussed. Or sometimes they're growing tremendously from a revenue standpoint, which is an accounting term, but their cash coming in doesn't keep up with the expenses going out. Those are real problems that need to be solved. The emergency strategies are just keeping the company alive long enough, hopefully, to address the real issues. As a cash flow advisor, your job is to help them see this clearly, to show them exactly how much money these emergency strategies are costing them. And sometimes it's not just cash, it's lost opportunity costs as well. Calculate it, put it into dollars and cents, and then help them implement foundational strategies. Go to the ones from the Boost the Bottom Line ebook I told you about. They actually fix underlying cash flow problems rather than just moving them around. Here's your action item this week. What I want you to do to become a more confident cash flow advisor this week is review your current clients and identify someone using some emergency cash flow strategy, factoring receivables or merchant cash advances or offering discounts early for advance payments or consistently paying vendors late, that their accounts payable is getting older and older, or that have credit card balances. That's a real great sign because credit cards are generally high interest rate, or they're offering steep discounts to increase sales volume. Those are all real symptoms of cash flow issues. Find a client using those one or more of those strategies, and then ask yourself two questions. Question number one: how long have they been using the strategy? If it's more than 90 days, it's not an emergency anymore. Question number two to ask yourself: what is their underlying cash flow problem that they are masking using these strategies? If you can figure that out, and maybe you can't, maybe what you need to do is schedule the appointment that you need to have with them to talk about it. And the appointment could go one of two ways. One is to talk to them about what's going on and go in with curiosity, not judgment. Here's a good opening line: I've been thinking about your cash flow situation. Or you could specify, I've been thinking about that you're getting further and further behind on your payables. You're taking deeper discounts to get your receivables in early. Sometimes they won't recognize the term cash flow. You can point out the specific thing that they're doing. And so I'm thinking about this, and I'd like to understand what led you to this situation that you need to get the cash in. Can we talk about what's going on? And so they give you permission to get to the underlying root cause. It will also help you understand whether or not they realize that they're trapped or whether they think it's just normal part of doing business. Either way, you have the beginning of a great conversation and of becoming their trusted cash flow advisor rather than just their compliance accountant or bookkeeper. If you want to jumpstart all of this, what I'm talking about in the Cash is Clear 5-step model, I'm inviting you to attend the immersive 4-day experience Pivot. It's an unconventional cash flow conference, and it brings accountants together at a hotel to learn the complete Cash is Clear framework for you to spend time during the day, in the morning, learning, and time in the afternoon for you to think and adjust your practice to implement working with clients. Thanks for attending today. Until next time, be the confident cash flow advisor your clients want.